All right. There we go. All right. Got it. Got it. Okay. All right. So I'm recording now. All right. So we're going to go back to this one. Now, was anyone else able to play around with this one a little bit? Because I did send out this template. So what I'm going to do, I'm going to go ahead and copy this into a sort of a new sheet, just so that I can kind of play around with it again, and I'll just call it, that's fine, 4.92. All right, and then what I want to do is I'm going to just put a whole nother set of numbers here. Okay, just so we're going to start from scratch again. All right, and then I'm going to clear out all of these numbers as well. Right. Okay, so we're just going to build this again from scratch, okay? All right. Okay. Okay, so, and then here's my P&L down here. So I'm going to just go ahead and start. So what I did, the way that this template works, hopefully you guys were able to kind of get some idea of this, is what I did is I have, I want to go ahead and put a beginning balance sheet, okay? Because, the balance sheet is it's a spot in time. Remember reading about that? It is a spot in time. So really what we're going to do is we have a balance sheet at the beginning of the period, okay? And then we're going to look at our balance sheet at the end of the period, right? And then the P&L is accumulation of all the transactions that happen over the period, right? And so we're going to be adding here. So what I want to do, they are related to each other, okay? And I think what might also be good is if we go ahead and create a cash flow statement, because I think that's another document that would be good for us to have, right? Cash flow. I'm going to go ahead and create that. And then we can create that when we're done with the other two and see what that would look like, okay? What I'm also going to do is I'm going to make this slightly bigger because I am having trouble seeing it. Okay, let's see if I can. That's smaller. Let's try that. Oops. Okay, there we go. All right, go up here. Okay, so our first, let's go ahead and do this. Let's go ahead and just put some values into our beginning balance sheet, okay? We just kind of come up with anything. So let's just say that we have $400,000 in cash starting right at the beginning of the year. Our accounts receivable, let's say, are another $500,000, okay? Let's say that our allowance for bad debt is about 5% of that, okay? So that's 0.05. And please stop me. If anybody has a question, just go ahead and stop me, please. So what we're going to do with this doubtful accounts allowance is we're going to make it a negative because it's a contra. In other words, it goes the other way, right? And then we're going to add the two together to get our total net receivables. Again, the net means it's net of allowance for doubtful accounts. So it's basically the 500 subtracting the 25 gives us 475 in net accounts receivable. We're going to say that we have supplies inventory of 30,000. Okay. And so then we're going to have, let's say another 500,000 of equipment, and our accumulated depreciation on that equipment we'll say is at half. That's 250,000. Okay. So then that means our net fixed assets, again, would be net, the actual cost of the fixed assets, which is the equipment, less the accumulated depreciation, would give us our net fixed assets, which is the 250, okay? Then our total assets, okay, and this one we're going to have to do this a little differently because we're going to be taking this summary. So cash plus the net accounts receivable plus the supplies inventory plus the fixed assets net of depreciation, okay? There's our assets right there, okay? Now our accounts payable, let's go ahead and assume that we've got 300,000 in accounts payable. Other payables, maybe we have 50,000 in other payables. sorry, 50. And then we have notes payable. Let's say we have 100,000. Okay. All right. So we've got 400,000 on our liabilities. All right. And then, so what we need to do is we need to balance, right? So our assets and our liabilities plus our equity are, which is what we're calling, actually this is liabilities and equity, sorry, not assets, liabilities and total liabilities and equity are going to equal the same as our assets, because again, you're balancing. So here's where we're talking about, there's the liabilities and then there's the equity section, right? And that's sometimes called the stockholders' equity. But it depends whether you're a nonprofit or for-profit. Okay, and it's also sometimes called retained earnings, and anyone's ever heard that term. But every year, if you were to make a profit, you would roll your profit into your net income or your equity section. Sometimes what you'll see in this section are like actually two lines. One is in fact called retained earnings. And then one is called net income. So what happens is this will be what you earned for this year, and your retained earnings would be your historical retained earnings. Does that make sense? Like, accumulated over many years, all right? What sometimes you also will see is that these sections on the equity are negative. And that would mean then that you've had losses. Instead of having positive years, you had negative years. And so that could be negative. The net equity could be a negative number, which is not good, but it happens. Okay, so then what this is essentially is just a plug, right? It's the difference between what the total liabilities and equities should be, and then what we know the liabilities are. So that's just a plug right there, all right? All right, so then let's go over to the transactions, right? Because we're gonna create some transactions here. Now, I can see that the way that I've done this is I'm having these statements just roll to a sum over here, and I'm seeing right now that something's not working, right? We've got, this isn't balancing, and there's no transactions, so we've got some kind of error that's happening over here. So let's just take a look and see where we might have an error. So this number right here you can see is 450 instead of 400, right? So I'm thinking, let's see here, the liabilities, okay. The liabilities are not adding in on this side. They're not adding in the other payables. You see that? So now there's 450, okay? So that number's now tying out, okay? But so one thing I want to also check is this tying out? We've got, yep, we've got our assets and our liabilities, okay, 1155. And over here, we've got 1155 and 1155. Okay, so that's all working now. Okay, great. All right, let's come over here now. So let's create some transactions, okay? What are we going to see happen? Let's first start with how much inpatient billings are we going to have? Let's just put some fictitious numbers in here. Let's say $750,000, okay? We're going to sell $750,000 of patient billings. How much of that are we gonna sell on credit? Let's say 500,000, okay? How much salaries do our employees earn? Let's say 450,000, okay? But let's say that we only pay out, when we actually pay, the payday comes, we're only paying out 425, okay? So there's a small amount that we don't pay out yet, okay? Annual depreciation, let's say is, I don't know, 50,000. Okay, bank loan, let's say is 200,000. Cash collected on billings, let's say, I don't know, 450. Okay, actually, yeah, that's fine. This one's. I'm going to change this one right here. Purchase supplies on credit. I'm going to actually make that a little bit less. I'm going to make that 200,000. Okay, just because I'm sorry, 200. I don't want it to be too high. Oops, more zero. Okay. And then we have estimated bad debt for the year. I'm going to use a percentage because I kind of like that. I'm going to say, let's say that it's 10% of our patient billings is going to be what we assume it will be bad debt or uncollectible. Okay. And then how much do we pay in our bank load? Our bank load's 200. Let's say that we pay 50,000. Okay. And last but not least, how much of the supplies that we purchased are we going to use in patient care? We purchased 200,000 of supplies on credit. Let's go ahead and say that we're going to use 50,000 in patient care this year. Okay. All right. So now there's probably two ways that we could do this. We could say, what we're going to do is there's always going to be two transactions, a debit and a credit, right? It's a double entry, remember? So when we have to think about what both sides of that journal entry will be, okay? And that will tell us where it will go on our balance sheet and our P&L, all right? So when we talk about patient billings, we're going to recognize that in two places. One is going to be in our receivables because we are owed those patient billings, right? So we're going to put that in our receivables right here. That's the first part of that transaction. So we're going to put the whole 750 in our accounts receivable. People owe us that. And then the other side of that is going to go down here on the income statement is revenue. Okay, so we're going to recognize all of those billings as revenue. All right. Anybody have a question on that? Okay. Please speak up. Okay, just go ahead and ask any question you need to there. Okay, purchasing supplies on credit. Okay, so we're going to go ahead and buy a bunch of medical supplies. We're going to buy more than we need. Okay, we're going to buy 5 times more than we need. Let's say there's a big sale. And we get them all delivered, but we know that we're not going to get an invoice for that for a while, right? But we got all the goods. We got the supplies. So we're going to go on our balance sheet, right? And we're going to find the supplies inventory line, and we're going to put that here. I'm going to put that under transaction number 2, supplies inventory, right? So we got $200,000 in inventory. But now we owe money for that because we didn't pay for it yet, right? We purchased it on credit. So let's go down to accounts payable, right? So in accounts payable, we're going to say we owe $200,000 because we purchased it on credit. So we're going to go ahead and have that be the other side of that transaction, okay? So essentially what we did is we created an asset and we created a liability.
So quick question.
Yeah.
If we had paid cash instead of credit, would that $200,000 instead of going to accounts payable come out of the cash?
Exactly. Let's do that quickly just so we can show that. So let's say that we had cash, we paid cash. So that would actually say then we would have go ahead and we would still have the $200,000 in inventory, but what we would have is we would have a reduction in cash because we paid for it in cash, right? So we would see our cash go down, right? And our inventory go up. So it's still a double entry. Okay, so whether you're increasing your asset and increasing your liability, or increasing a portion of your assets and decreasing a portion of your assets, it's all balancing. So right, that's sort of what I think Ashley you had asked about is like it's confusing, right? Like how do you think about this? But just what I would really urge you to do is just use your logic around this and just think about. If you had your own, if you think about all the things that are worth something to others and all the things that you owe others, which are your liabilities. And when you're making, if you're doing a transaction yourself, if you're going and buying clothes, right, you're going to have to pay for that some way. You put it on your credit card and you owe it, right? You'll owe it as a liability, or you pay it in cash. And then you don't have any cash. You have less cash. So, right, that those are sort of like, it's just more intuitive in that sense, right? Okay, so I'm going to go ahead and put that back down here. It's an accounts payable for now, right? That's what we said. So the reason it's not negative, just so everyone's clear, is that this whole section effectively is negative, if you want to think about it that way, because these are all liabilities and these are assets. They're always going to go the opposite way in terms of one's an asset, one's a liability, right? And that's why when we look at the the equity, it's going to be a balancing, right? It's going to be subtracting the two essentially, and that's going to be the difference. All right, let's keep going. Okay, so here we have salaries earned. Okay, so now the salaries as they're earned, again, we're using the accrual method of accounting. So when the salaries are earned, first we're going to say we owe them, right? We owe our salaries to our employees. Let's say we haven't paid them yet, right? They've put all their time in their timesheet, and we haven't run payroll yet. Okay, so they're recording their time, and so we know that we owe them. We'll just say other payables here. We owe them the amount of money. Let's see. So it's based in this case. It is, what do we say? $450,000. That's what we owe them. And so we're also going to record that on our P&L as an expense, right? Because that is a cost that we incur. A salary expense, right? We're paying our employees. I'm going to put it down one row. Sorry. Or we owe our employees. Okay. And then as we go further down, we say, okay, we've actually run our payroll and we've paid them $425,000. So there were a few time entries or maybe new employees that we didn't pay yet. We're going to pay in a week. So there's based on timing, often that's the reason why you might have a small difference there. We're going to go ahead and record the cash payout because we're paying them. So the cash is going to go down, right? We're going to do negative cash for the payment of the salaries. Okay, that's here. Whoops, negative. Okay, and then the offset to that is going to be the other payables, right? We just paid them, so we don't owe them all of that anymore. So now we're going to take that down as well. We're going to take that down by 425 also, right? So our liability went down, and we had to pay cash out. Okay, so that transaction does not impact the P&L. Because we already recorded what we earned on the P&L. We already recorded our expense, our full expense. Now we're just dealing with the timing of the payment, right? And here is the same thing with the receivables. We recorded our sales, but we haven't received any money for them yet, right? But they still go on our P&L, right? Okay, so we're going to go down now to annual depreciation. So we have a bunch of fixed assets and we've calculated their useful life, and we know that we have to book a depreciation expense. So that depreciation expense is going to be a contra. Again, it's a negative. We're taking $50,000 out of our assets. And the reason that we're taking that out is because we're assuming that those assets only have a fixed useful life. It's only a certain number of years. And when those years are finished, those assets are not going to be worth anything. That's what we're assuming, and that's why we take it out as accumulated depreciation, because we're eroding the value of those assets over time. That's what depreciation is, okay? And we're not doing it, but we're reflecting the erosion of assets over time, okay? And then again, that will show up on our P&L as an expense, right? So that's just going to be an expense in our P&L of $50,000, okay? Did I just put 500,000? Yes, okay, 50. All right, any questions on that? Okay, keep going. Bank loan. Okay, so we go to the bank and we say we need some cash. Can you give us some cash? So the bank says, yep, we'll give you, what do we say, 200,000? So we go into our notes payable. Okay, we have 200,000 that we're going to put in notes payable. 200,000. So we owe that money, but what are we getting? We're getting cash, right? So then we can put 200,000 up in cash. Let's see, there's cash. Okay. So we got 200,000 in cash now from our bank loan, but we still owe money for it. So again, it's both a liability and an asset at the same time. Okay. All right. Now let's go to, let's see. I'm going to just try to make this a little bit closer so I don't have to keep scrolling over all the time. Let's just see if I can make that a little bit smaller here. Okay, didn't really help that much, did it? Whoops. All right, guys. Just trying to get, okay. All right, so where were we? What's next? Cash collections on billings. Okay, so we know that we have $750,000 in billings that we sent out to patients, and we got $450,000 of that we've collected in terms of cash. Okay, so let's add that to our cash, right? We're going to go ahead and add the 450,000, right? And so what's the offset of that? Anybody have an idea what the offset of that would be?
Would it come out of the patient services rendered in the P&L?
Okay, share with me the logic around that. What are you thinking?
I don't know. I think I confused myself.
That's okay. No, it's good. I mean, it's good to think about it, right? So what we said is we provided $750,000 worth of service to patients, okay? And we recorded that on our P&L as our sales, because that's what we did. We provided that service. We are owed that money, right? That doesn't change. Our P&L does not change. It's still $750,000. But part of those patients, so then we created an asset, which means they owe us the money. They owe us $750,000. So now part of them paid that amount. So then what happens is we can then say they no longer owe us. We've collected on their receivables, so we can subtract now. We can subtract that out of their receivables, but we did get cash in exchange. So again, it's moving our asset from a receivable to cash, which is what we want to do. We always want to see our receivables move into cash, right? That's what happens, right? And we hope that happens sooner rather than later. We don't like to keep a bunch of receivables out on our balance sheet. We want to transfer them to cash. So that's what happened here. So in this case, we still have 400. We have what the difference between the 750 and the 450, which is 300,000 of those sales are still in receivables, right? They still are staying in receivables. And what we also remember, what we did is we had a $25,000 allowance for doubtful accounts, meaning maybe some of those won't actually pay. And then we already have sort of this provision for that, okay? And speaking of that, we may have another one here. Let's look. Okay, so we do, right here, estimated bad debt, okay? So we assume that of that total 750, that 75,000 we may not collect. So we're gonna make that, we're gonna record that transaction as well. So that's over here. That's allowance for doubtful accounts. We're going to add another 75,000. Again, that's a contra asset. It's taking our asset down. So we're going to put a negative. So it's a negative 75,000. So we're going to go ahead and find that here. Here it is. Okay, so there we go. Now, anybody have an idea of what the other side of that entry would be? So think of it this way. We originally thought we were going to have $750,000 in sales. We recorded that on our P&L, right? But then we came along and said, I don't think we're going to get all of that. We're looking at these particular, patients, and we just don't think we're going to get paid that. So we're going to go ahead and say, we're going to say that we're not going to get all that $750. We're going to get less. So what would we have to do if we wanted to adjust our financial statements for that reduction in receivables?
Take it out of the revenue?
Exactly. So we have to also show it on our P&L, right? And we have to say we're not going to get it. We can't record it in our P&L. So we have a bad debt allowance on our P&L as well. So let's go ahead and put that. Again, it's a negative, right? It's a negative. So that will then net that out of our sales, all right?
I had a question about how you did in transaction 7, where initially it was the patient billings was 750,000. So for transaction 7, where there is a net, if do we need to indicate that there's that 300,000 somewhere? Do we need to indicate that under the?
So what I did is, remember, you're reconciling from this side to this side over here, right? So you're adding up. So we actually had $500,000 in accounts receivable at the beginning of the year that still weren't collected, okay? And then we added 750 more in sales. Right? So that gives us $1.25 million in accounts receivable. Collected the 450. So then now our balance, if you look in the lower right-hand corner here, is 800,000. So let's go over to our sum over here. We should see 800,000. There we go. Okay. So that's really what we're looking at, is we're looking at what is our ending balance once we net out all the collections we got. Okay. So hopefully, in reality, this number would be bigger. If we had that much sitting in our accounts receivable, we would want to see more of that collected. I'm just using kind of fictitious numbers, right? So I probably should have made a bigger payable, because then something would be wrong with our business if we're only collecting a certain, not even 75% of our sales, and we still have a big amount left in our receivables, right? Does that make sense?
Yes.
So then the 300,000 is the net of these two things, but adding what we already had gives us 800, and then that's what's over here. Okay. So if we actually had zero here, let's just say hypothetically, let's just say we had zero. We didn't have any accounts receivable. We had already received them all. We already converted them all to cash. Okay. So then you will see the 300,000 over here, right? Because that's all we had, right? Okay. So
I'm sorry, I have another question.
Sure.
How come the initial allowance for bad debt doesn't show up on the P&L at the beginning either?
Well, remember, the P&L gets cleared out every year.
Okay, so
what happened is we did have it on the P&L last year, right?
Gotcha.
And then this year, these are all the transactions that are happening this year that go on the P&L. These are the results of what happened last year.
Okay.
And so then what will happen is when we create a new P&L at the end of this year, it's going to be zero again. So P&Ls start again every single year, and balance sheets just accumulate over time. Okay. Okay. Let's see, where were we? Okay, so did we do our loans payable yet? Oh, 9, not yet, right? Okay. So paid on the bank loan. Does anyone want to help me with that one? What do we want to do if we want to pay on our bank loan?
Subtract it from the notes payable.
Yeah. And what's the other side?
Cash, right?
Yep, that's right. So notes payable go down by 50, right? And cash goes down by 50. Isn't this fun? Okay. All right. And then last but not least, use supplies in patient care. Okay. So now this one, what happens with these supplies is that because we buy so many, we don't need them all. So what we don't want to do is we don't want to record them all in our P&L right away, because these are not going to be used for this period. We know that we're buying 3 years worth, let's say, okay? So what we're doing is we're putting them in our balance on our balance sheet as inventory. And then as we actually use them, we're expensing them to our P&L. Okay, so these may be things that don't lose value. Like, I don't know, maybe they're scalpels. I don't know what it is, but and they get stored and they're used and they're great, and we can, you know, use 1/3 of them every year. Okay, so then what happens is when we determine how many we're going to use $50,000 of these scalpels, right? So what we do then is we say, okay, let's take $50,000 out, right, of inventory. Right, so that's our transaction 10. So it's negative 50,000. And then we're going to record that expense right on our P&L because we're using it right now, right? So I think that would be supplies expense, okay? So that's here, right? Yeah, 50. Okay. So now the other way we could have done it is that we could have just bought 50,000 for the year and not bought any bulk, and then that would have just been you know, an accounts payable, like we bought them on credit, and it would have been an expense. It wouldn't have had to go through your assets section in that case, right? Because you weren't storing it. So that's sort of the distinction between that. If you're storing values, then you want to record them on your as an asset, right? Okay, so then that gives us, I think we got through all our 10 transactions now. Now let's see our P&L, right? Let's look at our P&L. Something looks funny here. Let's see.
I think the 50,000 for the supplies needs to be moved to column N. Not that it might matter. Or, I don't know.
Oh, I put him in the wrong one. Okay, sorry about that. Thank you.
Mm-hmm.
I just move it over here. All right, take it out of here. Okay, great. Now, I think the other thing that I'm noticing is that our P&L is not working, right? So what's happening here, it looks like, is that the sums aren't, the sums are summing, okay, but that's just that I'm missing one row. Oh, sorry, guys. This is what happens on a Sunday. Do you mind? I'm gonna go ahead and grab just one sec. I'm gonna add that up though before I go and see if that ties out. Nope, it's not, still not tying. This one needs to sum. There. Okay, hold on. Sorry, guys. Okay, I'm back. All right. So we have $750,000 in revenue. We have 75,000 in our allowance for doubtful accounts, right? Our bad debt allowance. So our revenue is only $675,000. We have $450,000 in salaries. We have $50,000 in supplies. Our depreciation expense is $50,000. That gives us a total of $550,000 in expense. So our net income would be the difference between the two of $125,000. Okay, and then that net income is going to roll to our equity section of our balance sheet right here. Okay, and I'm putting that down as transaction 11, just so we can see where it goes. Okay, so there it is. All right. So our equity section then, and I'm just going to see if this is working out here. So we originally had 705 in our equity section. Okay, now I see that's not actually, oh yeah. And then we have the 125 here. So if we add them together, we should have 830, right? Yep, 830. So that's kind of where we are with our equity. So we've got all of our transactions here, 1,653,000, right? All the transactions. We've got all our ending balance. I shouldn't say transactions, I apologize. These are all our ending balances, given our beginning balance plus our transactions that we just did, beginning balance plus all the transactions, right? Would give us our ending balance. Okay, same thing with the liabilities and equity. So now we're balanced. So you see that? We've got the P&L, the assets and the liabilities and equity together. When you subtract them, they are balancing. Okay, and that's exactly what we want. We want to see that balance like that. Okay, so let me just take a pause and see if you have any questions, and then we'll build our cash flow next. Does everybody get that? Did everybody follow all that?
Professor, I have a really quick question. Is this something like could we expect something like this on the exam?
Yes.
Okay, because this kind of brings it all together, right? So
it sure does.
You said the P&L always, the beginning balance is 0.
The beginning of the whatever your fiscal year is, you start with 0, right?
Okay.
Yeah. So it records your operations over time. So what it's doing is it's saying how profitable is your company over a period of time. So it's a tool to say, are you making money as a company? Right? How are you doing? You sell X amount of goods and your expenses are Y. How are you doing? Are you healthy? Are you not healthy? And then the balance sheet is sort of like where you're keeping all your money. All the things you own, you're keeping track of them, all the things you owe, and then any sort of retained money that you have made in the past, or your shareholders, if they've given you money, you have to put the value of what they purchased there, right? So that's how you kind of keep track of those two statements, all right? Let's do the cash flow now, okay? Okay, so what we do with the cash flow, we'll come back down here. So cash flow, we always start out with our net income, okay? That's the first place we start. Okay, so what we're saying is, hey, we generated $125,000 worth of income, okay? And actually, maybe I'll start over here. Let's start over here, okay? That's what we generated for the year, okay? But we know that some of that is not cash-related transactions, okay? So what we're going to do then is we're going to take out anything that's not a cash transaction. Okay, and at the end, what we should see here is we're going to try to, through all these transactions we're about to do, we're going to see that our cash should tie to our cash balance right here, this 575. That's what we're looking for, okay? That's what we want to tie to, okay? That's what we're hoping for, right? So one thing we want to take into account here is that we have a beginning balance in the cash account, okay? We've got $400,000 that we started the year with in the bank. Okay, so what we're going to do, what we normally do is we can say we have a beginning balance. Okay, so let's do a beginning balance. Why can't I spell beginning balance? I don't know why I can't spell it. Okay, forgive my spelling here. Beginning. I'm going to do this again. And my keys are hard to.
It's okay.
Oh my goodness. Now I've got all the pressure, right? Okay, there we go. All right, so beginning balance we know is 400,000. Okay, there we go. All right, so we got our net income, and then what we're going to subtract. Does anyone know the first thing we subtract? Depreciation, right? Depreciation. We know that that's a non-cash expense, right? So we're going to take that out, all right? So we know that we have $50,000 worth of depreciation that happened this year. So we're gonna subtract that. So let's get our net cash, right? All right, and that will be the 125 less the 50. Okay, so really, although we made $125,000 in net income, if we remove our depreciation, we will see that I went the wrong way. I'm sorry. We're adding it. We're not subtracting it. Sorry about that, guys. We are subtracting our depreciation expense is what we're doing, okay? So we recorded $50,000 worth of expense on our P&L, but we knew it wasn't cash related. So we want to take that out when we reconcile our cash. Okay, so even though we only show 125 in net income, if we remove that expense, we would have received 175. Okay. So again, we're trying to only look at the cash changes. All right, now what we want to do is we want to look at our balance sheet and say, okay, well, we know that there were certain things that we accrued, right? And that we didn't get everything for. Like a big one would be our receivables, right? So we know that our receivables, we added 750,000 in receivables, and we only got 300. We only were paid for 50, right? So we know that that's a change of 300,000. So our receivables went up by 300,000. So that's another cash item that we've got to account for, is the change in receivables. Okay. Because we didn't actually receive that in cash. So that would be, we're going to say that is going to be a $300,000 change, right? So when you think about it, that's going to be a reduction to cash, okay? Because we didn't actually convert that to cash. So we're going to take that away. Then we're going to look at, let's see here. We're going to look at the next item, okay? Let's go this way. We had supplies inventory. So the only thing that hit our P&L on our supplies inventory was our usage of the inventory. But we know that we had to, we received assets, right, for $200,000. And that we owe the money, okay? Neither of these resulted in a cash transaction, but the way that we look at it often on the balance sheet is, instead of paying for this, we have it as a payable, okay? So we like to think of that as it's increased our cash because we didn't have to pay for it yet, okay? And so what we did is we ended up paying for it later, though, I believe, right? We had a transaction, I think. Let's see, didn't we? Accounts payable, 200. Let's see. Purchase sales on credit. So I don't know that we actually.
Transaction 10.
What was that?
Is in transaction 10 the 50K?
Yeah, no, that's when we actually use the items. So there's nothing in here that says that we actually paid for those supplies yet. Right? We don't have that as one of our transactions. So what that means is that we still owe the money for those, right? So if we had paid for them, then we would net the transactions here, right? And I do have something here as a supplies inventory. Yeah, because we're using it, right? We're using it. So what we want to do for this is we want to go ahead and net these. So what we're saying is we had $150,000 in changes that we didn't have to pay for, right? We didn't have to pay the cash for, right? So the additional 50 down here is going through our P&L already, and it's being reflected in our net income that we're already showing. It's the balance sheet that we have to reflect now. So what we've got to do is we've got to say that our changes in payables, and that's what we call it, changes in payables. We didn't pay all this. There's 150,000 left that we didn't pay. So we can say that we increase our cash. I know it's kind of hard to understand that, but that's the way that this statement works, okay? So those are two pieces. Let's keep going. And then we have, let's see, we did the supplies. We did our, let's see here, our receivables. We didn't do our net of doubtful accounts, but that actually went through our P&L as well. If you remember, we had a $75,000 that hit our P&L as a bad debt, so we don't have to record that either. All right. And then let's go to, this is our notes payable. So this is all completely a balance sheet transaction. We had $200,000 in notes payable. We were able to pay $50,000 of it back, right? And so what happened is, if you look at our cash, that actually ended up being $150,000 that we added to our cash, right, net, because we received that note. So what we like to think about when we look at our cash flows, that's a financing type of transaction. So we're going to say we financed our operations by using $150,000 or borrowing $150,000 of cash. Okay. All right. So let's keep going then. And what's left is we've got, I think we counted for this one as well, right? This is our supplies. And yeah, okay. Let's see. I don't think I'm forgetting anything. Let's see. Do we have any equipment purchase? I'm trying to remember if we had anything there. No, I don't think we did, right? Okay. All right, all right. So let's go down. Let's see now if we actually got, so what we're going to do is we're going to show our net cash for the period, our net change in cash. So we're going to add up all these changes that we just talked about, right? Including our net income, all right? That's $350,000 of cash that we actually had for the period. So we're going to do a ending, we have our beginning cash up here, right? Which is the 400. I'm going to just highlight it. And then we're going to do our ending cash. Okay. All right. So then we're going to say beginning cash, 400. Ending cash, change in cash, 350. That gives us 750. Okay. In ending cash. Now let's go back up and see what was the number we were supposed to get. We were supposed to get 575, right? Okay, so let's go back. Let's just take a quick peek and see what did we forget something, okay? So I'm going to actually take that number of 575 and put it right here, okay, just so we can keep track of that. This is a good way to do it, is when you're kind of looking at your transactions to see what you might have forgotten. So we'll just put that there, okay? So we've got a variance still, right, that we have to account for of 175, right? 175. Oh, okay, you know what I did? I realize now what I did. I didn't, when I looked at my net cash, I think I just added everything up. What I should have done is either I have a subtotal in here, okay? So I'm going to take this subtotal out and just not even include it, okay? So once I take that subtotal out, all the items that I included here should be adding up to 175. And then if I add that 175 to my beginning balance, I have 575 in my cash, my ending cash. Okay? So that's what my cash flow statement looks like. Right? Any questions on that? So does everyone, understand sort of what we went through there, or was that confusing?
It seems like there's a lot to account for to build the three statements.
Yeah, so I think that hopefully the P&L and balance sheets a little, now that we've been through it a couple times, is that a little better, do you think?
Yeah.
For me, it is.
Yeah, and I think you should, continue to kind of play around with it a little bit. The cash flow is a little tricky because with the cash flow you've kind of got three different areas on the cash flow. You've got your net income and your depreciation, which gives you sort of your net operating results, if you will, right? Which sometimes you can just put as over here as a net number. You've got your balance sheet changes, right? Which are all those things we just went through. And honestly, sometimes people just add up all the changes in their balance sheet and then they just kind of add it. And then you've got your financing, you do any debt or anything like that. Those are kind of your 3 areas of your cash flow. And I'd urge you just to look through the book again because it describes those 3 areas. But I think the balance sheet is probably the trickiest. And remember, really all it's doing is it's summarizing the changes in the balance sheet. Okay? That's what it's doing. So at the end of the day, you're reconciling and you need to get to the cash amount that you have on your balance sheet. And that ties out. So, yeah. Okay. That's an hour. Can you believe that? That's already an hour.
Wow.
Can you please summarize quickly how you got how you made sure that you balanced your net income on the balance sheet?
Okay, so basically what happens here is the way that you take your net income from your P&L, which is the 125, okay? And that's the last thing that you want to roll into your balance sheet. And you put that in retained earnings. So that's the last transaction you make is adding your net income to your balance sheet in your equity section, okay? And once you do that, once you add that item to your existing balance, when in our case it was $750, that should then allow your 2 statements to tie.
Okay.
If they don't tie, then you would probably do what I did before, right? I looked at, okay, so how much am I off? And let me go back and see if I can find some transaction that might be equal to that amount, so then I can try to problem solve and find out maybe what I did wrong.
Okay, that's helpful.
Okay. Okay.
Okay, thank you.
All right, great. So I'll go ahead and I'll stop the recording and then we'll go ahead and post this out there too. And definitely just go through it a few times and hopefully it will be helpful, okay?
Thank you.
Thank you.
Thanks everyone. Take care. Bye.
Thank you.
Mm.